600 लिसनर भी आ गए हैं। ग्रेट। तो हमारा समय भी हो गया है, तो स्टार्ट करते हैं इसे। तो सबसे पहले मैं हालांकि समित भाई को किसी इंट्रोडक्शन की ज़रूरत नहीं है, सारी इन्वेस्टिंग कम्युनिटी उन्हें जानती है, लेकिन फिर भी एक औपचारिकता पूरी करनी है। Samit Vartak ji is the founder and chief investment officer of Phase 1 Investment Managers LLP. Samit has been investing in the equities market since 1999 and has experienced and studied many bull and bear cycles over the last 2 decades. He has worked closely with various global companies in the US and India. He also advised them on business strategy, profit optimization, growth, and valuation. Since Sage One started managing clients' money in 2012, the assets under management have grown from below 2 crores to above 2,500 crores. Thank you, Samit ji, for joining us. और आपको मॉडरेट कर रहे हैं ईश मोहित अरोड़ा। उन्हें भी किसी इंट्रोडक्शन की ज़रूरत नहीं है, सभी लोग उन्हें जानते हैं। ईश मोहित इज़ ए co-founder of School of Intrinsic Compounding (SOIC), the leading YouTube channel in India for investors with over 120,000 subscribers. Great. Known for its top-notch content. Previously, he has worked with a family office that follows principles of value investing. He is currently managing his family office and teaches and SOIC. और मैंने भी ईश मोहित के वीडियोस देख के बहुत कुछ सीखा है और बहुत ही अच्छे होते हैं। तो ये आज का सेशन अब हम शुरू करते हैं। Over to Ish Mohit.
Thank you so much for the kind introduction, and I think it's basically it's a pleasure to moderate the session with Samit sir, and over to you, Samit sir.
Thank you so much, Saket ji and Ish Mohit. It's so kind to call me to such a big group, and I really am looking forward to the discussion. This is my first such session ever, and hopefully you will find some value in whatever I have to talk. But do feel free to have a very candid discussion. I am open to any sort of discussions, other than, obviously stock ideas and those kind of things. But really looking forward to the session, and thank you so much for the kind words.
Thank you, sir. So just starting with some basic questions, what is the core investing philosophy of Sage One?
Sure. See, so Sage One basically, since I started, my target has always been, if you are investing in the stock market, after all, it's a risky asset class, compared to bonds, fixed income, and hence, you have to make higher returns. You can't, if you are especially investing yourself, spending a lot of time, then my expectation was that if the market gives you 15% return, then you have to get at least 5 to 10% higher returns than that. Otherwise, not probably time well spent. From that perspective, the goal was to generate that 20 to 25% return, which is doubling of money in 3 to 4 years. And if you have to do that, then even the companies that you have, they have to double their earnings, because without earnings, you really cannot, get, in the long run, you can't really make returns, which is too much, away from the earnings growth. So basically, the Sage One investment philosophy is look for companies which will double their earnings in the next 3 to 4 years. So, we are not looking for companies which are extremely cheap and poor quality businesses. The first thing which we have to look at is the business has to be strong. If it meets the business standards that we are looking for, only then you go for valuation. Because see, valuation is something which you can take a little bit risk on, because if you get the business wrong, there is high chance that you will permanently lose the capital. Valuation, even if you go wrong, it's okay. Sometimes okay, you let go of a year and a half year of returns. But in the long run, you'll not lose money, and that should always be sort of the top priority. In addition to obviously making high returns, but you have to look at your downside. And the best way that I've seen, I've done those mistakes, going for really cheap companies, looking really cheap at a P multiple level. So best quality will be available at 40 times, and then the cheap one will be available at 15 times. But that 15 times goes to 5 times, and then the 40 times goes to 60 times. But so that is how generally the markets work. And from that point of, after burning my fingers, going for really cheap valuations and not so good quality business, this is where we stabilized, and has worked out pretty well. And it works across industries. Doesn't matter which sector you are looking at. And that basically forms the foundation of Sage One's investment philosophy.
Right. I think that is a very profound thought, that valuation valuation should always be secondary, and the business analysis should always be the primary aspect to look at it. So one more question linked to this. I think in one of your memos you mentioned that how between 2000 to 2010, and then how between 2011 to 2018, we have seen winners from multiple sectors. We have seen winners from multiple sectors that have emerged. Like basically between 2003 to 2008, we had the infra and the infra cycle and the real estate cycle. And between 2015 to 2019, we had the cycle of chemicals, NBFCs, and pharmaceuticals. So what is like your key criteria for filtering down on stocks?
See, now when you look for such a growth, typically you don't want that growth to be funded by too much of leverage. So I mean, generally, if your return on equity is close to the returns or close to the earnings growth that you're looking for, typically, that should fund itself. So internal accruals should be the key source of funding for growth, because most growth doesn't come without spending on capex. And hence we look for, if I'm looking for 25% growth, then even the ROE has to be 25%. So that is the starting point. But more importantly is, the company needs to have control over its profitability. So that's where we don't end up investing ever in the sort of cyclical space, because the profitability is dependent on global commodity prices, which neither the promoter has any idea what will happen to the global cycle, nor, I mean, investor is far away from that. If the promoter doesn't know, I mean, very rarely would the investor know. And hence, it needs a lot of luck, to play the cycles, to get in, get out at the right time. And so we look for such businesses. Now, you rightly said, in the sectors which do well, very rarely would see that the same sectors will continue to be high growth sectors. If you are looking for 12, 14, 15% kind of growth, or maybe even 17, 18%, you will find many companies which will probably do that. Especially pretty good lending companies, finance companies can do that. And there are also a lot of consumer oriented companies which may grow at that 11, 12% consistently for a long period of time. But when you look for this 25% kind of a growth, then the game completely changes. You can't bet on something which will go on for 15, 20 years. You have to think from a very short, it's more like a relay race. So we don't follow buy and forget and just hold on forever kind of investment. If it happens, okay, you buy a stock at time zero, and every point in time you keep on evaluating. It is also possible that certain businesses will continue to offer what you're looking for a pretty long period of time, and they may end up becoming a long-term investment for you. But when I start, my holding period, I'm assuming, is about 3 to 4 years, because that's where I expect that the stocks will, deliver what I'm looking for. And hence, my sectors can completely be different. And I had presented in one of my memos that if you look at the high growth companies in that first decade versus the second decade, there was barely any common name. Probably, one of the banks or, high growth. But if you look at the recent decade, it's been decade of Bajaj Finance, specialty chemicals, pharma, API theme, a lot of some building material. Um, and if you look, and then of course the FMCG kind of have gone up in valuation, but I mean they haven't really grown at 25%. I'm looking at more from earnings growth perspective. There are very few industries which will grow. And you look at the first decade, it was more real estate, infra, some new brands which were coming out like Titan, and of course financials, which were dominant in those high growth segments, right? So it is all about, you can never predict which is going to be the next theme. What I like to do is let the theme start playing out, and then you evaluate, is this something which is sustainable for a long period of time? And then you get a lot of players. When you do bottoms up investing, that say I would do, you do by talking to management, by evaluating companies who are just starting to grow. You get a sense that this is definitely a long term growth. And is this company something which is competent enough that it will maintain its profitability? Does it have enough competitive advantage against its competitors, where it will keep on doing that for a long period of time? And you go for these themes. I mean, I can tell you, see, looking back, you might think, I identified Infosys and it has given, but when you start, you have no idea, zero idea about what even investors, even the promoters, say for example Deepak Nitrite, when Deepak Mehta put up his plant for phenol, uh, I don't think he had any idea how it will do over the next 3. After all, everyone is definitely taking a risk. It's an calculated risk, but there is no certainty to how the business will evolve. So how does an investor who doesn't have even 1/10 of the knowledge of what the promoter has about his business have any idea about how it will evolve? Right. So the best thing an investor can do is, every point in time you just keep on evaluating that business, how track the competition, what everyone is doing. And if it keeps on getting better, if it maintains its profitability, sustains its competitive advantage, and there is growth available, you keep on holding it. That's how I work. I don't really look at 10-year kind of themes at all, because I do not have the ability, and I don't think most of the promoters have the ability, especially in the high growth businesses. Very slow, systematic growing businesses like FMCG and those kind of, where these are all stable companies, paints, you will probably have much more predictability in those businesses, but they will not be that high growth businesses. And I think way of investing completely changes depending on what kind of growth rate you are looking at. And hence sector is something which comes out from bottoms up. It never really starts from top down, at least for me.
I think that's again a very profound insight, because sometimes the entire sector does well because of tailwinds. Like in chemicals, Deepak Nitrite, Naveen Fluorine, PI Industries, Aarti Industries, Vinati Organics, or a Clean Science recently, all of them have been doing well. So so basically an approach from bottoms up and then tops down, basically a top down approach, actually tells you which sector is experiencing those tailwinds. So linked to this question, sir, I had this question that why is it important to adopt a probabilistic mindset? because a lot of investors I talk to, so everyone is seeking certainty. But as you rightly pointed out, that when you're looking for a very fast rate of growth, then there is a lot of uncertainty involved as well. Just as an example, in 2015, 2016, when Deepak Nitrite was putting up the phenol plant, I think they had to do 3 rounds of QIP, and their balance sheet was also very leveraged. So how do you make peace with this aspect of uncertainty, and how does that uncertainty reflect in your position sizing at the end of the day?
Right. No, it's a very relevant question because again, I said, the kind of returns that you target, the kind of companies you're looking for will determine how you structure your portfolio. So, for example, if you are, say, a very high risky venture capital investment, it's a more of a startup investment where the failure rate is pretty high. Out of 100, maybe barely 5 will really be successful, and one or two will deliver humongous kind of returns, and that too if you're lucky. So if you are building a portfolio of venture capital, typically you need a lot of companies in the portfolio because to get that 2-3% to that 2-3% successful sort of investments, you need it, right? If you just do it in 10, most of the time, 10, all the 10 out of 10 will turn out to be not those 100x kind of returns. So if you are looking for those 100x plus kind of returns, which probably out of 100, 2 or 3 max will probably deliver those kind of returns, you need to build up that kind of portfolio, because even if 3 deliver that 100x kind of returns, and even if you put 1% in each company, that itself probably delivers that 3x kind of returns and makes up for everything else going down to zero, right? And now, say if you go for safe investments, which is say guaranteed bonds kind of investment, there you can just invest in one instrument like a GSEC, or there, because there is no uncertainty of failure, because if someone is promising you buy a 10-year bond and gives you 6.2% return, you will make that 6.2% return if you hold it until the maturity, right? Whereas what you are looking for, now if I'm looking for, so those are two extremes. What I'm looking for is basically that 2x in 3 years or 2x in 4 years, and that turns out to about 10x in 10 years kind of and as I said, there is no certainty to this. So you have to make up your mind how much risk are you taking of, and you are not investing into a turnaround story or a startup. So the certainty of uh, earnings growth is there. What extent of earnings growth generally is not known. So on an average, the entire market itself grows its earning at 13%, 14%, right? So what you are looking for is basically double the earnings rate of that. And for that, my experience has been typically if you build a portfolio of about say 20 stocks, out of those 3 to 4 will deliver you earnings growth of 10x in 10 years. If you're decent, good, track these companies well, understand the businesses well, out of those 20, 3 to 4 will deliver you 10x in 10 years kind of returns. And 10x in 10 kind of returns, if they really happen, even their multiples, the P multiple go up, sometimes from anywhere from 2x to 6x. So you get those 10 to 20% of your portfolio stocks, which will deliver you that 40x kind of a return. And the remaining, even if they deliver you market returns of that 13%, you do get 10x in 10 returns at a portfolio level. But to get those 3 to 4 stocks, you need around 20 stocks in your portfolio, or at least 16, 17 stocks in your portfolio. If you just reduce that portfolio size to less and less number, that's you hitting and getting that 40x kind of returns in few stocks definitely reduces. So the risk does go up. So it depends on how risky investment you do. The higher the risk, obviously the portfolio has to be more diverse. the lower the risk, the size of the portfolio, goes down. Accordingly, I mean, you will only know what kind of risk you are taking, and depending on your strategy, if you are going for turnaround stories, really, sort of startup listed businesses, then you need to spread that over larger number of stocks. Whereas what we look for is more of already existing companies which have been doing pretty well. They're just going for higher growth, and you can evaluate those. And for us, that 15-20 kind of, between that 15 to 20, is reasonable, sort of a good balance between not spreading your bets too thin, as well as not taking too much of a risk.
Right, sir. Again, very profound thought. So, linked to this is like in last 3-4 years, I've been watching a lot of your interviews and I've been reading a lot of your investing letters. And one of the key mental models that I've seen you talk about is a company's capability to gain market share from its competitors. Can you please explain this mental model with an example of 1 or 2 companies?
Yes, absolutely. See, if you look at most things in life, nothing really remains stable. You have to evolve. You have to evolve with change, right? And to only survive uh, against competition, you have to remain ahead of the game, right? And what does it mean? The result of remaining ahead of the game is basically market share, because across the board these days the rate of disruption has just increased. It's gone through the roof. And businesses used to last 30, 40, 50 years before today, in the probably the first part of this century, and then that length of business survivability has slowly been going down, just because of the evolution. It happens so fast, right? So see, it's about how do you reduce your risk. What are the uncertainties? The uncertainties are basically whether economy will grow. There is no certainty to it, whether the economy will grow at 6%, 7%, 8%. Like we have seen in India, the expectation what India will grow at 8% or 10%, whereas we ended up, in the past 5 years, barely growing at 5 or 6%. So there is a lot of uncertainty, irrespective of whether you got the prime minister that you want, you have everything in your support, but there is no guarantee of that happening. And below that is the industry growth, whether the industry will grow at that level or not. There is no certainty to it. Similar to, you can't predict economy's growth. It is very difficult to predict industry growth, because there are a lot of moving parts which have to fall in place. Now, if you are targeting this high growth rate, and what if the industry doesn't grow much, right? So what is the more riskless way of growth? Is taking away market share, because we have seen. So for example, I've spoken about this company multiple times, even APL Apollo. If you see last 5-6 years, the industry has gone nowhere. It's just been there. It's just that they did disrupt the market, by bringing in new technology, the direct farming technology, where the wastage of time when you change the setup from one size to another was barely, couple of hours versus, sometimes 24 hours or 48 hours, right? So that itself, first of all, reduces the cost. That gives you an ability to take smaller orders, which are highly profitable. The other conventional guys will not be able to do it, because why waste one day and supply an order of just say 10,000 tons? So the economics itself changes. You are able to deliver and take away market share because of this disruption that you have created in the industry. I mean, imagine, instead of getting the supply in 2 or 3 weeks, you're able to deliver in 3 to 4 days. I mean, that's a huge shift, because it saves working capital across the supply chain. And those are the disruption which enables you to take away market share. So in an industry which has zero growth, the company has grown at its volume at 15 to 20%. And then with volume, with economies of scale, you have margin expansion, and earnings growth is generally higher than the volume growth. So this is something which gives you a lot of because anyway, if you are looking for really high quality business, gaining market share is the most important proof that it's a high quality business. If you have a high quality business, which doesn't take away, for example, I was invested in Hawkins long time back, but realized that, okay, it produces the best quality products, but then it is so non-aggressive in marketing, in launching products. It is happy with what it's doing. So a cash cow is something which do not deliver returns for an investor. If Hawkins was aggressive enough to basically take advantage of its brand and the product quality and move ahead and take away market share, it would have been a much bigger business. It would have gotten much higher valuation. And even if the industry doesn't grow, it will have significantly higher growth, which for which it will get that premium. So market share gain is not just a strategy; it is reflection of lot of other things which you are already looking for in a business. Because if there is no market share gain, you are just looking for high quality business, which is just growing at industry standards. What is the proof that it has that competitive advantage? So for me, market share gain is the biggest proof, and which also helps me deliver that kind of above industry average kind of growth.
Right. I think competitive positioning is defined by a company's ability to gain market share over the years. So, in one of your recent interviews, so you pointed out that how private consumption, corporate balance sheets, exports, and finally the government balance sheet is falling in good shape. Now, what do you think are the implications for different themes if one is looking to basically look at different themes for with a horizon of next 3 to 4 years?
समित भाई आप म्यूट पर हैं।
हेलो, अभी आ रहा है? सॉरी।
हाँ जी।
हाँ, so basically, it's very difficult to preempt and be invested in a theme which you expect will play out, because as I said, there is too much uncertainty. It rarely happens. So for me, I like to look at the ground level data, what it's showing me, whether I can have a thesis in my mind, right? So accordingly, I like to position my portfolio. So what I'm seeing is that, so one of the data points which are clear, in the balance sheet, is that companies have become very lean and mean in the sort of really tough phase that they have gone through over the last 3-4 years. Plus, they have made their working capital cycle very strict. So, the credit period that they used to give has shrunk. And that has enabled them to collect a lot of cash, way higher than the earnings growth. So in my memo, I've shown that in the last 2 years, the cash flow growth is 250%. Earnings growth is probably not even 120, 110%. And similarly, it's reflected that even the market cap has grown by about 150%, and the cash flow has grown way above that, right? So now it gives you a couple of abilities. One is, once you are debt free, you do get sort of daring to put up new capex, because until you are under the burden of debt, and when the economy goes through such a rough phase, it becomes very difficult for the promoters to take a call of going for capex, right? So definitely companies will go for capex. So that definitely is sort of more of a certainty. And you look at the environmental clearance applications, they are also at all-time highs. So that's a leading indicator that the companies are looking for expansion. Plus, the government has given you 15% tax rate if you commercialize your plant by March 2023. In addition to that, there is PLI scheme. Government is focusing on a lot of export-oriented businesses, because now there is an opportunity away from China that anyways I think it's a humongous opportunity. But in addition to that, government needs to focus on creating employment, and we can't just create enough employment if we continue focusing on just the consumption of India. So we need to focus outside of India, and that's what I think this PLI is for, right? So then the third thing which is emerging is that in the last 7-8 years, there is no rise in the real estate prices, and if you look at the salary levels over the last 7-8 years, they probably have gone up by 2 or 3x. And typically, this top 4-5% of the population is what really makes the biggest difference in most of the discretionary spending, including real estate, the discretionary white goods or large ticket items. And at the same time, so no change in the real estate prices, the salary levels going up by 2 or 3x. At the same time, the EMIs have gone down by 30% because 10% to 7% kind of a drop. Right? So real estate also looks like a new theme. And the common ingredient for both of these themes, whether building factories or real estate, is building material. So I think building material as it in itself is something which is, you can see bottoms up. A lot of companies having high growth. Whether it's the steel pipes kind of a companies or electrical cables or tiles. So something which caters to building factories or building residential real estate is something which both those themes, as well as directly investing in builders itself, that theme looks really good. And then similar to that, as I said, government has to focus on creating employment and export oriented. So export oriented themes, which in which a lot of these, whether it's IT sector or whether it's the specialty chemical, CRAMS, API businesses, they fall into that segment, because it's a room. I think people are underestimating the way China plus one will work out. Take an example, right? If you look at the Chinese, lot of chemical companies, they are forced to move away from urban to sort of rural area. Now, that is fine, but if you know how China works is that if you lay off people, then they have to compensate them for typically n+1 number of months. Then if they have worked for say 20 years, so 20 plus 1, 21 months of salaries is what they need to be given, right? And so if you're moving from one location to faraway location, not many people would be willing to move along, and plus the cost of moving is to be taken by the company itself. Government is not going to fund it. Plus the second generation of those promoters, a lot of them are moved out of China. They don't want to continue with these kind of businesses. They probably want to move. So if you're anyway shutting down a business and then taking complete take care of the setting up that new plant, why would so many companies want to set up? So there is going to be leakage. That not 100% of the companies will be able to go and set up a new plant. And at the same time, I feel Chinese, the kind of businesses they have made successful, and at the extent of how much incentives and support the government has given, whether it's in terms of very cheap land lease, or cheap electricity, easy approvals, all of that, very low compliance of pollution norms. I think that's history, because the way the debt, and you can see it through that Evergrande kind of default, that debt, it's just a sign of the kind of debt, because it's like an Amazon model. Just keep on funding the losses until the competition dies, and then post that you make up the profits. But not everyone turns out to be an Amazon. Many companies will perish before that, and I feel a lot of industries in China, could face that uncertainty because the government no longer wants to support. Now it is going more socialist from a really extreme capitalist, and it could help India. I mean, if India really takes advantage of this opportunity, there is pretty large opportunity available, and at the same time, the corporate balance sheet strong enough that they don't really have to take debt to fund this expansion. The banking balance sheet has also become very strong because lot of the loss-making industries like metals, mining, textile, they have become so profitable they themselves are paying off all the debt. And so India has really strong banking balance sheet, really strong corporate balance sheet, as well as really strong government balance sheet. Because who would have thought that the income tax collection and the GST tax collection would be sort of all time high, and which is happening right now. And then the fourth is the consumer. Consumer is also pretty strong. As I said, the top 5% population is what really spends on the big items, and they contribute highest to the incremental growth of GDP. The rest do consume the basic items, but then that would add up to that typical 4 or 5% kind of a GDP rate. But this incremental is where the salaries have just gone crazy, in the last couple of years. And then a lot of people have made so much money. In my memo, I've shown just in the last 1 year, not even from March, just September to August, the market cap of India has gone up by 100 lakh crores, which is humongous. It's 45% of the GDP, out of which you can assume 20-25% maybe is FIIs, but the remaining is with promoters and the retail investors, either through mutual funds, DIIs. So, I mean, that kind of wealth creation will definitely give you support for consumption, and so you look at these kind of changes which are happening on ground, and accordingly bet on the right things, but don't preempt. Let those things start happening. So like right now you are seeing real estate volumes picking up, inventory going down. So if you're seeing those things, it's time to bet on it. So rather than, because if you just go ahead of time, it's almost good as going wrong, because you will probably lose patience by the time it really starts picking up. So better let it start picking up. You might be late for by few months, but that's okay. That's where you reduce your risk.
Right. So I think the basically the next question was actually linked to this theme only, the entire RE cycle. So in terms of almost after 13 years, there has been a 15% increase in salary. There has been 37% reduction in new supply. And there has been a massive consolidation of builders, and the inventories are massively falling. So in terms of this entire cycle, like how are you planning to play this cycle? Either through some proxy plays, something in tiles, all through basically builders like Suntech or India Bull Realties or such type of companies.
Yes. So see, I like to play indirectly most of the times. So if I'm looking at building material theme, I would like to play it through, like structural steel pipes or electrical cables, those kind of play. If it's real estate, yes, tiles players or housing finance companies. Or if you really find a good builder where there's a huge risk reward in your favor, because a real estate builder is all about location, where their properties are, what kind of demand that property has. And so you can build up a portfolio which has all these ingredients. And building material, if you get players which cater to factory building as well as real estate construction, nothing like it, because that itself reduces the risk. Right? So you build a portfolio of 4 or 5 such companies which all will benefit significantly from the real estate play the going ahead.
Right. And linked to like one more theme is about financials. So if we are seeing an if we are seeing an economic recovery, so then no economy can grow without credit. So what do you think about financials? As the starting valuations also seem to be favorable in this case, especially in some tier 2 or tier 3 financials with which are basically very good asset quality.
Yes, see, financials, at an individual level can do well. I am not so positive on the financials mainly because of one is I think growing corporate credit will be difficult given that the companies have just deleveraged themselves and many are generating enough cash that they should be able to fund their capex through internal accruals. So why would they go for debt? I mean, many of companies have already, just paid off the debt, and generally it doesn't happen that they will immediately go for, financing, especially when they are generating cash. So corporate lending growth will be difficult, and generally it's a big driver of credit growth. As well as if you look at the sort of lending, unsecured lending, which is to the 95% of the population, which 95% of the population will, would have come out uh, worse post COVID, because they were probably employed in a lot of unorganized sector which has suffered. Small MSME businesses, whether it's small restaurants or small businesses, taxi drivers, those kind of, they have been badly affected, and so even their lending will become risky. So corporate, and I'm not saying that it's going to degrow, but when you look for growth, it has to offer you growth. It will be very difficult without the support of unsecured lending as well as the corporate lending growth. And see, also the dividend policy is going to make a big difference because the biggest dividend is taken by the promoter. And when you get charged 43% in your hands, how many of the promoters would really want to pay out that much of dividend, which they themselves receive most of it? They would rather invest that capital into capex rather than, paying out dividend and then borrowing money, which a lot of companies used to do before. I think that will go down. So I'm not worried about the quality of assets at the banking level because that generally is a worry sign. It's more about the growth, which I feel they will struggle. Another area which will probably also struggle is going to be the auto sector, which, because you look at the cost of manufacturing autos has gone up. The running cost of auto has gone up because the petrol prices and diesel prices have gone up. In addition to that, there are, customers may want to wait and watch of how, Ola Electric develops and what kind of other options do they get on the four-wheeler side. So there is a disruption which is ahead of you, and those three factors, can have impact on the growth rate of that industry. I'm not talking about degrowth. I'm just talking about the growth rate. And of course, investment is all about looking for sort of that alpha in growth. And I feel that kind of alpha in growth you will not find in, corporate lending, auto, unsecured lending, those kind of segments.
Right. I think it's an industry that is going through a period of headwinds instead of tailwinds right now. And one more very interesting opportunities or themes that are emerging is that we have already seen this play out in the developed world. That a lot of SaaS companies or the new age internet businesses are getting listed, and they've done phenomenally well in in countries such as US or China. And companies like Salesforce or Shopify, I think in last 4 to 5 years, they've been almost 30-35 barrels. So are you like trying to stay ahead of the curve and trying to find such companies being listed in India, or are you just trying to study? Are you just trying to research or are you just trying to research on them?
Yeah, right now, it's more about just trying to understand their business models, because one of the biggest, I think, differences between what has really worked in US versus, say, what's different in India is that one is most of these companies have come to the listed market pretty late in the game, when they are pretty much entered. It's not a startup kind of phase. They have been there for 5, 7, 10 years, and then most of the juice has been taken away by the startup investors or the private equity investors. And actually, you would be buying from those most knowledgeable kind of investors. So that is one issue. And second issue is a lot of US players are global in nature, which offers them biggest sort of long duration of growth, and that may not be available for India because India would be still catering to the Indian population. And I think sometimes India as a population number looks really high, 135 crores. But the real population that matters to most of these companies are going to be, that top 5% of the population, which probably would be, just about 10, 15 crore of population. And many of them have already basically are already catering because the digitization happened once Reliance Jio was launched. And that's when the huge expansion happened. And we are, 3, 4 years past that. If this was an investment which was happening before Jio was launched, and when people will get access to internet and they will become, sort of digital customers, that would have been opportunity. I think listed players are getting this opportunity a little late. I may be completely wrong, but the risk reward doesn't favor you because I was just looking at if I'm looking for and I'm getting opportunities where the returns will be double in 3 to 4 years. If I'm investing in such businesses where there is so much uncertainty, my expectation will be rather than making 2x, I need to make 3 or 4x. Right. And when I look at the valuation, the starting valuation where you get the entry, and to make that 3 to 4x kind of return, what are the kind of multiples and earnings? They just don't, line up. And that's where, so until, we get comfortable on that business model because it's new, no one has any idea. The uncertainty of how this business model, because the disruption can come through global players, you don't know how and where the disruption will come through and whether and I mean you will make money if they end up becoming the disruptors because in this industry it's more and more about the disruptor and whether they will be the disruptor for the next 10 years or is it just the disruptor at the initial stages and the other competitors will catch up. There are a lot of uncertainty, which as an investor who hasn't really tracked this industry for a very long time, it doesn't give me that comfort. But there could be investors who know this industry is in and out. There are a lot of venture capital who probably ran this such businesses. They are now become investors and they understand these businesses way better than I do. But and they can probably predict how they will evolve and they can take those kind of bets. I am definitely not there yet.
Right. And linked to the question of portfolio themes and everything. So one question which always disturbs me, or one thing which I struggle with, is when to sell. Like, what are the key triggers for selling? Like, there are key catalysts for buying as well. And at the same time, what will be some of the key triggers which actually make you sell a stock?
Yes. See, it's a very, very difficult question. No one really can master this. You most of the time see the biggest mistake. So there are two, to take the right sell call, actually just two side of the same coin, right? Because the biggest mistake that you do is that you don't get out of the company when there are issues and you get out too late or you get out too early from an investment just because you see some signs of trouble. And there is, 5 years more when that stock goes up 10x or 20x more. So it's a tricky situation because you take the decision based on that current situation, and the risk could play out either ways, right? But I feel the biggest risk is letting go of a company too early in the game at the first signs of trouble. Um, as I said, out of the 20 stocks, you will get barely those two or three such big multi-baggers. And if you just let go of one of them, you end up hitting your returns big time, right? So, see, whenever there is slowdown, because after all, when you invest in a company, you have certain expectations of growth, how it will evolve as a business. Whenever results disappoint, that's when you have to dig deeper into what exactly is causing that kind of slow growth, right? You can give it a quarter or 2 quarters, to see if this is a short term, because you will not know really in 1 or 2 quarters whether it's a short term or long term, right? But most of the businesses will never have a straight line. They will go through uh, those dips in performances. Whether you are expecting 25%, it will just grow at 5%, because the growth itself will be volatile, for most of the businesses, because it's not the bonds that you're investing in. Now, only if you have understanding of the business, which is in depth, where you can make sense whether it's a short-term issue or is it structural change which has happened in this business, that is the only way you can figure out whether to get out or not to get out. If you realize it's a structural change which has happened to the growth or to the business model, you just get out. For example, uh, I was invested in Kaveri Seeds, since 2009-10. I think it had gone up by 15x or 20x. And by 2015, around that time, Maharashtra government came in and they reduced the price of the cotton seed packet, and then they capped the pricing. I mean, for me, that's a big structural change, because first of all, government is coming in and it's trying to control the price, which itself is a huge no-no for any business, uh, and it's reducing the prices. So for me, it's an easy decision that you just need to get out. In finance companies, for example, in J&K Bank, around that same time, you found out that it had lent. It was, I mean, a J&K state bank, right? And it one fine day, you found out that they have lent to REI Agro in West Bengal, and 600 crore, which was pretty big size for them. That shows you, I mean, there is something wrong in the lending practice. Either something which is driven by illegal sort of incentives, or so if you realize that, you just get out. Difficult exits are when they are about businesses, just pure business calls, where there is no shortcut but to understand that business uh, well. And it's better to be little late in exiting, but making sure, like, because you don't want to lose out on that 30-40x kind of an opportunity too early in the game, just because there was small hiccup in the business. You just need to talk to more and more participants in the industry. Management talking would not help much, because they will obviously give you the right story that you want to hear. But talking to the competitors, talking to the supply chain participants in the supply chain is what will help. And for me, selling decision is all about, if the growth doesn't meet my standards of doubling in 3 to 4 years, if it's slowed down, I generally get out. And of course, it's not based on my expectation of next year's earnings, or it's just more over that longer term period, based on my best guesstimate or estimate of the growth. So growth generally becomes, one of the big reasons for my exit. valuations are rarely large, number of exits for me. I'm okay with little high. I mean, of course, I don't buy at any valuation, but if I say what's comfortable buying at 20 times multiple, it's gone to 40 times, 45 times, I'm okay with that. That never becomes, especially the business is going to deliver what I'm looking for, and I'm okay compromising a little bit on the valuation side. Of course, if I get a better opportunity, which is as good, but if I'm getting it at lower price or lower valuation, I will switch it. So especially if it's in the same industry, similar kind of drivers, I will switch it. So that could also become one of the reasons for exits. But exits is something that needs to be thought through depending on your strategy. If your strategy is to go for cyclical businesses, it's a lot to do with market timing and the cycle timing. You need to understand those cycles pretty well, right? So those exits are already known that you will exit this stock once the tide changes, and there probably you need to take much quicker call. You can't wait too much to ascertain that, because by that time the stock would have fallen by 30-40%. So depending on your strategy, the exits reasons can be completely different.
I think that was a very comprehensive answer with case studies. So for all the retail investors over here, I just have a question, because like everyone who experiences the market also experiences this aspect too. And in one of your memos, you mentioned that how concentrated the returns of Sensex are. And basically, during 38 years, Sensex has risen by almost 250 to 300x. But if one had missed the 1% of the days, the returns would have been close to zero. So, how important is it to stay invested in the markets?
Yeah, absolutely. I mean, that's how concentrated the returns are across the globe. It's not just Indian markets, it's across the globe. So I mean, the markets are so dynamic. In one of my memos, I had written that you can't analyze the market from a framework of physics or mathematics. A lot of liberal arts. Lot of, because market participants themselves are thinking way ahead of how things are going to evolve, and they already take positions before the actual event happens. So I mean, how the markets come out of a event is very difficult. I mean, just look at when Trump got elected, everyone thought it was such a negative event, but right next day the market just went up, and it never stopped for for many years. Who would have thought, in COVID? Because imagine that COVID hit us. The lockdowns happened in March of 2020, but if you were given a crystal ball where you could see how COVID is going to affect the economy, the lockdowns, how the economy is going to be, completely shut down, a lot of business, would you stay in the market? And if you were given two choices, one is stay invested in the market or stay out and invest after say 1 year. Most investors would have taken the choice of staying out of the market for 1 year and then getting back, because by that time, and you were completely given the future that this is how long the economy is going to be impacted. There will be second wave, there will be third wave. Most would have taken that decision of staying out of the market for a year and then getting back later on. And look at the reality. Everyone would have gotten it wrong. So very difficult to predict markets, because it's a science which is a lot of art, liberal art, a lot of psychology involved. So better to stay invested, because generally when you get out, you will get out at the wrong time. You will make decisions which will be based on, for example, now, right? Because the markets have, there will be a lot of recency bias. So because the market went through a lot of tough times, in 2018, 19, and suddenly then, investors started making a lot of money. Because of this recency bias, you will always feel that I may lose out on these profits. And then typically you would want to book out really fast as soon as you make money. And many investors, I mean, a lot of fund managers probably have seen even last year, by that in July 2020, around that time, most investors recovered the losses that they made in COVID. And that time, there were many investors who redeemed portfolios and see where the markets are today. Because there, lot in a whenever there is a bull market, there were a lot of factors which will try to take you out of the market. There will be such taper talks. There will be such China kind of issues. There will be such issues every year. And when the markets run up too fast, you want to protect your capital, but it doesn't really work out. Very few investors are able to get out at the wrong time, because you get out too early, it's almost impossible to get back into the market. Same thing happens in a company that, say, you were invested in Bajaj Finance, say adjusted for the prices in 2009 at 50 rupees, and then you get out at 500 rupees. When you get out at 500, you cannot get back at 2000. It is extremely difficult. Very few investors would be able to do it. And then even if from 2000 it can go to much higher levels, it's very difficult to do that. Same thing happens with the market. So most often it makes sense to just stay invested, because very few of few have that extraordinary capability of timing the markets right all the time. Some people will do it in 4 cycle, maybe they will get 1 cycle right, but it's not worth that kind of tinkering. If you are in good quality companies which will grow, you have to ride the price levels. Main thing is the earnings going in the right direction? That is all in your hand. What will happen to the valuation is absolutely out of your control. So don't try to control that, and it's never worked. I also tried to do it at the start of my career, but that's where you have a lot of confidence that you can time the markets really well. As you gain more and more experience, that confidence just goes down. Then you realize you cannot time the market. And yeah, after 20 years, I definitely feel it's very difficult to time the markets.
I think again that's a very good thought, that after 20 years of experience, like it is extremely difficult to time the markets, and I think it is something which I, I don't know if many people can do or not. So just one more question in terms of, since you're managing money professionally, is that how do you manage the client expectations? Because experience of a client who entered the markets in 2018 collapse will be way different than someone who entered the market in 2020, and how important it is to partner with the right set of clients.
Sorry, my mute button is really slow. When I press it, it happens after like 5-10 seconds. It's extremely important that you get the right set of clients. And unfortunately, what happens is that majority of the clients tend to come in at the really bull phase of the market. No one really, very few people dare to start their investment or come to you when the markets are in really bad shape. And so it's just inherent nature of this industry that you will tend to get the biggest money when the markets are stretched. And that's where, to set the expectations right and gauge whether this investor you know, is made for equity investment. It is your judgment also which is important, because it's okay to say no to investors, because You don't want to take investors who at the first sign of panic will get, so panicky that they will start calling the fund managers. And you don't want to be managing the investor at that point, because those are the opportunities that you are always looking for when you find really juicy, attractive, companies at that point. So you want to focus as much as possible during that time. And for us, over a period of time, we have realized, see, our minimum is 2 crores. And one of the key reason is because of that, is that once the investor has to give you 2 crore, he will think 10 times before you give the money. So there, whereas when we started, the minimum was on only 25 lakhs in the PMS, and people would put money blindly into the PMS without really understanding the risk of this business. So by keeping that 2 crore, lot of such investors who just came in blindly without really understanding the risk got eliminated. And most of the time, as a fund manager, you get to talk to these investors, because everyone wants to talk to you before they put in 2 crore, which is a pretty, high amount. And you do get to gauge what is the risk taking ability, whether they have seen cycles, and you want such investors. And fortunately for us, most of our investors are that. Even during COVID times, I don't remember even getting 2 or 3 calls. Most of them understood that this is something beyond the control of the fund manager. If you are comfortable with the portfolio companies that you hold, you just have to ride through it. And through my sort of conference calls that I do with investor, the quarterly calls, through my memo, I generally try to, prepare the investors, because even today, even though I am positive on the next few years for India, and I really, from the depth of my heart, feel that this is going to be the decade for India. But in stock market can easily go down by 15-20%. So that is something which, you can mentally be prepared for. But when it really happens and your portfolio goes down in a matter of 2-3 weeks by 20%, 25%, very very few investors can really take it. People can get cheated, because whatever money you made over the last year and a half, once you start that just diminishing, then you tend to get panicky. You want to probably just book out and protect whatever profits that you have. But those are the rights that you have to take. If you have to make a 10x, 30x, 40x, 50x kind of returns in any stock, that stock will go down multiple times by 30-40%. It has happened with Bajaj Finance. In my experience, it has happened, with PI Industries. Deepak Nitrite didn't go anywhere for a long period of time. APL Apollo didn't go anywhere for a long period of time. I mean, in 2018, it went to 2,400 and then came down to 1,000 during COVID time. So I mean, you have to take those rights along with you. The bottom line is that if the companies are delivering, that's what the investor needs to get comfort from. And as a fund manager, it's your job to educate the investors what are the right things to look at in a portfolio. You can't just look at the numbers, the returns, because many times it's about right time, right place. Because if I launched a large cap strategy in 2017 or 18, when the small and mid caps were falling, you would, and then large cap in really quality stocks, you will definitely you would have, just because of your mandate, you would have outperformed the markets. Doesn't mean you have inherent ability to outperform the market. It's just that right time, right place. Whereas if you had started this, large cap strategy year and a half ago, post COVID, you have underperformed the overall markets by a huge margin. Most of the portfolio managers you would have underperformed. So it's how you basically educate your set of investors is what will give them resilience to stay through tough uh, part of the market. And I think every fund manager's job is to keep on, continuously doing that.
Right. I think as in one of your talks, you mentioned that the importance of being lonely in your investments, like um, uh, especially when you're looking at businesses which are just like coming up in terms of new prospects and in terms of just showing strength in the earnings growth. So one question that I had for all the youngsters who are basically attending the session and for all the investors is that what will be your key advice to them in terms of learning, like in terms of your own experience from the markets. So one key advice to all the investors who are attending the session.
Yes. My, main advice would be, see, as you get more and more experience, your ability to evaluate businesses have to go up, because I think that is the only way you can continuously outperform the market. So study different businesses, study different industries, why certain business is doing way better than the competitors. It can be very different what's happening in India versus what's happening in the US. So just by reading most of the books which are US made, doesn't mean that you will gain enough knowledge to evaluate companies in India. Like Warren Buffett says that, he wants to invest in companies where, management doesn't have much role to play. Even if it's run by a monkey one day, it should be a running business, which absolutely doesn't happen. If you try to do that, in India, you will probably end up losing all the money. In India, the person who runs the company, the execution is one of the most important aspect, that one needs to look at. I mean, every company that I have invested in, which have turned out to be a multi-bagger, it is because of that whoever was running that company, whether it's Rajiv Jain in Bajaj Finance, or Mayank Singhal in PI Industries, across the board, Deepak Mehta, in Deepak Nitrite, even a lot of specialty chemical companies. It's because of so, and then every industry is so differently run in India. So the more you evaluate different businesses, the more you evaluate different industries, you'll get a lot of insights of what really makes a good business. And that knowledge is something which is incremental. It keeps on compounding over a period of time. So after a while, uh, it is something which will become sort of part of you. So, one of the things which I think I have learned over a period of time, which is uh, investor or the new investors spend a lot of time in reading. I know everyone advises you on reading a lot, but it should not become sort of an addiction, because reading can be very relaxing. It can be, entertaining. But once you read few books on investment, there is very little incremental return on time that you get uh, on such. Once you read, I think you need to spend a lot of time in thinking about what you have read. That thinking is becoming less and less. We get bombarded by so much of data, information, reading on WhatsApp, on email, on through books, some PDFs, research reports, that we just spend most of our time just reading, reading, reading. Whereas we spend very little time in thinking about those readings. Once you think, play different scenarios about businesses, about and I would say if you spend 10 hours on reading, then spend 20 hours on thinking about it. One of the example is that, when I read about, say, valuation, right? Valuation, you can easily just read Damodaran's book. You will get to do know most of the things about valuation, at least the fundamental theoretical aspect. But then when you come to India, you look at the valuations of FMCG companies, valuations of building material companies, same growth, similar kind of ROE, and then they getting valued so differently. One getting valuation of 80x, something getting valuation of 15x. You think why? Question why across different businesses. That gives you much more insights. That thinking, evaluating different discrepancies is what gives you a lot of knowledge, and that knowledge sticks with you. It keeps on adding, and that is something which I would definitely advise. And again, just because something has worked for me doesn't really have to work for you, because it's not about just one way of investing. It has to match with what you like, what your temperament is, and accordingly, whether you are good at such kind of investment, you do that. There could be very different kind of invest. Sometimes, you could be a great business picker, timer of market cycles, timer of industry cycles, and you could do really well. Some people don't even meet the management, right? They can just read the annual report, just broadly look at businesses and get an insight into how that business is going to evolve. For me, what works is I have to go meet the management, look at the plant, and visit the plant, talk to the supply chain. I need to get much deeper insight, but not necessarily something that you have to do. But I would say, more than gathering information, more than just getting bombarded by data, just focus on the most relevant data. Don't waste too much of time, going through everything, reading through everything that you get. Think much more about your investment style, what kind of businesses you like, and that will help you a lot going forward. Even if you make mistakes, just think, what is it that made you make that mistake? Was it not understanding the business, maybe not spending enough time, or is it just part of probability? It is also, however in-depth research you can do, you can spend all kinds of hours and times, but there is risk involved. More businesses, as I said, not even the promoters know how it's going to evolve. So you can go wrong. Many times you will go wrong, but you need to see, whether it was just that probability which played out, or there was something which you should have caught, which you didn't, and why didn't you catch. So don't get into that guilt feeling. Just evaluate why it happened, incorporate as part of the learning, and keep moving on. You just need to keep on moving on, evaluate different industries, and I'm telling you, 10 years down the line, you will be 10x better investor than you are today. And that's the only way you can compound your knowledge, by just studying different businesses and industries.
I think that's a phenomenal insight, because all investing it's about pattern recognition, and especially since we have very low literature basically a lot of Western investing literature is available instead of Indian one. So I think that becomes very important to do these case studies over and over again. So with this, we can have questions from the other moderators and the investors. And thank you so much for basically agreeing to do this, Samit sir.
Thank you, Samit ji, for your great insights. This is Sahir here. So I had a question with respect to management. You'd said you give a lot of importance to management here, especially in the Indian context. And you also mentioned that you do a lot of channel checks, whether with the suppliers or you go meet the managements, etc. So what I wanted to know was, when you assess management, is there anything that you do differently from other investors and fund managers? And is there anything unique that you look for in the management, and even in your scuttlebutt, do you look for anything unique in the supply chain or ex-employees, or yeah?
Yeah. Hello. Okay. It's so no, Sahil. It's not. It's not. Anything unique. Initially, when I came back to India in 2006, and I used to meet promoter, and he was not probably good at communicating or not talking well. I thought, this is not a sophisticated promoter. Can he really scale up that business? But you get surprised the way Indian promoters may be not good at communicating, but they are excellent executioners. So I like to look at, one is how they have done historically, how they have executed, what kind of capital allocation decisions they have taken. And for me, that becomes a starting point. But I do like to understand how and why they are doing certain capex, what exactly is going to change to disrupt the industry. They need to have that kind of specific knowledge. You should not go after just investment because you want to keep on investing and growing the business. There has to be a specific plan, and so that execution plan is very important for me. And then you looking at history, whether they have been able to execute what probably they have said before is important. The work culture is important because, see, most of the time, or the management is not to really look at their ability of manufacturing and all. I mean, that's an added advantage. But you do get a sense of whether that promoter is a micromanager or is he a good delegator. Because you to execute at such a scale where you want to go up 10x and 20x, in the next decade, 2 decades, you can't do it alone. You have to rely on people. You have to hire talent and delegate. That is the only way you can professionalize a business. So that aspect is very important for me. Almost across the board, whether it's, I mean, you can imagine where Bajaj Finance was versus when they got the talent of Rajiv Jain, and he ended up bringing most expensive talent from the financial industry, and look at the way they've executed. Uh, Similar is the case for whether it's the PI industries, even APL Apollo, Sanjay Gupta. Slowly, he is bringing in the talent. He's trying to professionalize setup. He is thinking of bringing in the technology way ahead of others, and he is thinking 3, 4, 5 years down the line how this industry is going to evolve, and how do you just remain ahead of the game. So that kind of thought process is something which I keep on looking for. I haven't focused much on the corporate governance and on all of that. That is a very different thing. See, again, investors, as I said, do spend a lot of time on looking at last 10 years of annual report, and looking at reading a lot about history. That is okay. I mean, I do spend some time on that, but I think the real evaluation comes in from the future. You need to understand the game plan, how they are going to disrupt that industry. I spend a lot of time on understanding the future rather than just the history. History, I feel, is just the starting point. And once you dig into the promoter, question him in detail, I think a lot of those, whether it's just a superficial plan or is it a thought out plan, it comes out well in in that interaction. And when you talk to the supply chain, does give you confirmations about whether is he just a good storyteller, or is it something which in reality is going to execute. So over a period of time, you again, so as I said, when I came to India, probably I made those very poor judgment errors of categorizing promoter based on the communication skills. A lot of that is behind. It's all about the action that I look for, and it's all about the plan and execution that I look for.
Thank you, Samitji. Thank you so much.
So, thank you, Samitji, for taking time out of your busy schedule for this session. So, and I also Yeah, so and I also wanted to thank you on behalf of Share Academy as well. So it's a YouTube channel, and currently this session is also getting streamed live on YouTube with around almost 550 people watching right now, and it will further watched by thousands of people. So I guess it's going to be a massive validation for all the investors who are listening in. And just a small announcement, like if anyone in the audience has any question for Samit ji, you can communicate those questions through back channel to any of the moderators, and the moderators will take up those questions. Yeah. So Samit ji, you had mentioned that the most of the money that comes to you comes in the period when the markets are stretched, right? And that is the case with you can say retail investors as well, right? A lot of investors come when the markets are heated. So how should a knowledgeable person, the person who has sound knowledge of markets, should go about building a portfolio when market conditions are heated? Or perhaps you could explain how do you manage the money which is coming during the heated market conditions?
Yeah. So see, actually, if you look at the returns of in one of my memos, I think it was towards the start of the year, I had presented that whether it's a cyclical company or a structural long-term story. So if you compare the returns of say Tata Steel versus a lot of FMCG kind of companies. Hello, I'm getting some disturbance.
Yeah, you're audible,
Um,
Samit.
okay, so the returns aren't much different over the last 20-year period. Right? The problem is in the volatility in the returns. Right? So when you manage professional money, outside money, where you can't control the timing of inflow and outflow, it's even more important that you focus on long-term structural stories. Because say you are expert in cyclical stocks, but since the cyclical stocks didn't do anything in from 2008 to 2000 18 19, you probably would be a dead fund manager. Your business would not have survived. So when the cycle really picks up, by the time you show your performance and collect the money, the cycle probably will already be over. So most of the money that you will get, because you are doing so well in the last 1.5 years, will be towards the peak of the cycle. And most investor in absolute terms will be losing money, even though your CAGR might show great returns, right? So the only way you can actually, for a professional fund manager, you have to focus on businesses which are structural in nature, which will end up doing well, irrespective of whether you are in a economic bull cycle or a down cycle. Those are the kind of businesses which you have to endeavor to have in your portfolio. And then the matter of inflow and outflow has lesser relevance, because, and again, as I said, you have to educate the investors, because you end up, so for example, I have a track record of say 10 years, and my returns are 30% CAGR, right? But if you look at say 2-3 years of moving average, that will range from anywhere from 17% to a high of 60-70%. So there is, and if you reduce that moving average cycle to 1 year, it will range from minus 27 to plus of 180%. Right? So the shorter time period you come in with, you have to be ready for that sharp drop in your portfolio. Whereas you extend your investment horizon, then at least the probability of you losing money reduces significantly, especially once it goes beyond 3 years or so. There is no guarantee that you will not lose money, but it reduces significantly. So when an investor comes in, whether it's at the top of the cycle, it's important for you to set expectations that since you are coming at the top of the cycles, when investor come in at the top of the cycle, of course the average returns are going to be below the long-term average that say a fund manager has made. So when the expectations are set right, the investor is aware of the risk of the portfolio going down by 25-30% at any period in that. If he's ready, he can ride through that cycle because at least he was made aware of that. But if he comes in at the peak of the cycle with expectation that he will also get the returns of the last 1.5 years, that is a completely wrong expectation from his point of view. And if no one really, and many a times there are a lot of new investors who come into the market just because they hear so many people around them making money, and they are absolutely not aware many a times, and they're not ready for such a fall. So if you end up having such an investor, you will go through a lot of stress, more stress as a fund manager than the actual investor goes through. And yeah, it's all about setting the expectations right.
Yes, yes. So I was present in the 2018 presentation that you made at CFA Society in Delhi. So in that presentation, you made a comparison between cheap Nifty 50 stocks and expensive Nifty 50 stocks. So I believe you had said that if you look at the return over a 10-year period, those returns are like there's great divergence between the returns. But if we increase the periods to 20, 30, 40 years, the returns are much more comparable. So do you still hold that view? Because we have seen like the expensive stocks have become even further expensive in this market. So does the view still hold?
See, what I had said during that talk was I had shown history of Nifty 50. It was in the 1970s in the US with sort of this decade in India, right? So, and then for India specifically, I had shown that if you look at the high quality stocks, where you put in those consumer oriented FMCG kind of players and compare with the generic Nifty kind of valuation, their valuation was pretty similar in the first decade of this century. It was around that 25 times, 25 times kind of a multiple. Right? The divergence started happening after 2011, and there was specific reason. If you understand uh, how Indian economy was, in 2011-12, that's where a lot of those scams started coming out from the previous government. The parliament went through a complete, standstill. There was not much capex. Banking system was already stretched, and Indian economy completely slowed down. And that's where these, until say 2010, if you look at that decade, the growth of whether it's metal stock or cyclical company, long-term structural consumer-oriented stocks, the growth rate was pretty much similar. The economy also was growing at a nominal rate of that 12, 13%, which a lot of these consumer stocks were growing. But they, after 2011, their growth rate continued at that 11, 12, 13% kind of figure. Whereas the rest of the economy, especially the non-structural stories, cyclical kind of stocks, all kinds of commodity, metals, textiles, some, auto, their growth rate just went down to 5%. If you look at the Nifty's growth rate during that phase, 2011 to 2000 and maybe 19, 20, it's barely 5%. So that divergence, that alpha that these companies created attracted a lot of capital because it shows as soon as you start growing consistently, the investor, when they have less opportunities around them, will flock towards those limited opportunities. And that's where the companies which are trading at that 25 times kind of a multiple went up 2 or 3x in terms of valuation itself. And that's where they returned, in addition to that 12%, 13% kind of a growth, there was incremental return of 7-8% because of this 2 to 3x kind of valuation multiple increase over that 8-9 years kind of a period, and that's where they generated 20-22% kind of returns. But same valuation re-rating is not going to help you going forward. Your returns now would be driven by more earnings growth, and when other opportunities become available, which are higher growth, cheaper stock, people will tend to switch. More and more people will now invest in metal stocks or commodity stock, textile stocks, various other opportunities as available for growth. So it is also possible that that valuation re-rating which happened can derate. I mean, it may not go down to that 25 kind of valuation multiple, but 70, 80 can come down to 50, 40 times, and then that 12% kind of earnings growth, if it gets dampened by sort of the valuation derating, your returns will be even lower than that. But those are, you got to evaluate why you got the returns of such significant alpha during that phase. And if you started investing during that phase and you saw such companies delivering significant alpha, doesn't mean it's going to be happening even in the future, because the circumstances have changed and the starting point itself is very different today than then. So again, as I said, the thinking is what is needed. Just looking at statistics and just studying history doesn't matter. Is just a starting point. You need to evaluate whether it really applies at any point in time.
Right. I think you also made that point in that presentation. Ki 1990 from 1998 to 2008, and then from 2008 to 2018, there was no common. If we look at the list of top performing stock, there were no common stocks in those two lists. So, do you see any any sectors in the future that could perform really well over the next decade?
Yeah, I mean, I think, see, it is extremely difficult actually to predict the themes which will work out, and that's where I generally don't try to predict such themes. As I explained against what Ish Mohit had asked regarding what kind of themes, and I said I take a short-term view and let that view keep on holding for a long period of time and let that become a long-term view. But I will always look at the next 2, 3, 4 years point of view. Today, the companies which are emerging in that theme, as I said, is into real estate, is into building material, is into export oriented, whether it's IT or specialty chemical, uh, pharma, APIs. And that's what I would migrate towards. That's where my allocation will be, and because they're already delivering that kind of a growth, and then you just track it, get more and more knowledge about that specific themes which is emerging from your bottoms up stock picking, and you hold it until it stays valid and it keeps on meeting your hurdle. Once it stops and you think the tide has changed, you because there are too many moving parts in the world where it's almost impossible to really predict a theme for a very long period of time. Just as COVID hit, there could be something else which could hit, and people were talking about now a long-term super cycle for commodities. But who knows? I mean, what if this China, financial issues and default really blows out of proportion? Then China is the biggest driver of commodities. It could just falter. So better to just evaluate based on current data, what it's showing you, and change your mind if that data indicates completely different. I mean, for example, year before today, I mean, who would have thought that India's balance sheet will become so strong? No one in its wildest imagination after COVID, when things were just struggling, would have thought that India will be in this position in terms of corporate balance sheet, consumer balance sheet, government balance sheet, and the export opportunity. And that's how there's no point in trying to predict, too much ahead. Just look at, I think, just short term, more like a relay race. Keep on just passing that baton ahead. It could be, maybe in the same theme, but there's no point. I at least I do not look at that 10-year kind of a horizon. I am fine looking at just 2 to 3 years kind of horizon and moving on.
Right. Thanks a lot, Samitji.
Thanks, Samit, for joining us. Very insightful session. I just had a quick question about, I believe one of your offerings, your large cap portfolio with the passively managed strategy. So if you could tell us a bit about this, is it because we believe there isn't much alpha left in large cap stock? And broadly, how do you look at, apart from Sage One, the role of systematic or quantitative passive investment in the large cap space as the industry in general?
Hello. I don't know because my unmute sign still shows it's unmute and probably it's already. Okay. Can you hear me?
Yes, we can hear you.
Okay. Sorry. Okay. Yes. See, I believe it's extremely difficult to generate alpha in the large cap space. It's not that easy. The only way, and there is passive strategy which you can try to take longer term structural stories within the large cap space. And if you do back testing, then a lot of that you can at least evaluate whether it creates alpha in all kinds of cycles. Because the important thing is you don't want a strategy which works only in one specific cycle, and because of maybe reasons which are only relevant for that cycle. So we launched the large cap because we did not believe that we had the ability to generate too much of an alpha, and it's worth spending that much full time in the large cap space to generate that alpha. Just the passive focusing on certain parameters which have really worked for us. So one is high return on equity and capital. Then cash flow generation compared to the book profit generation, and also looking at the growth. Those are the three parameters. We created a formula out of it, which delivered the best alpha over the last 20 years. And based on that, because large cap is, if you are not doing an active strategy, better to offer something which is very competitive. And we thought that is something where we can't really add value by spending too much time evaluating and doing the same work that we do for small and mid cap, talking to the supply chain and talking to the management, visiting factories. It's not going to add too much of incremental alpha by doing all of that. Hence, that passive strategy worked, and we offered at a really, really attractive, fee structure. And again, it's also it completes sort of the portfolio, product portfolio for us, because many times small cap and mid caps are very volatile. They can go up crazily, but also can come down significantly. At that point, some investors may want to diversify away and allocate more to the large cap. So rather than sort of redeeming from Sage One and having to go somewhere else and then wanting to come back when the cycle returns, they have this option that it's a very, because within Sage One, it's just a matter of sending out an email and switching from mid cap, small cap to a large cap, and you can do those tactical kind of allocation within the firm, and that was the idea of launching the large cap passive strategy, and then continuing our efforts on the active strategy, which is in the small cap and mid cap portfolio. So we have a mid cap portfolio and the small cap portfolio, which is actively managed.
Understood. Thanks for that.
Hi, Samit. I've been a big fan of your work been following you since 2018, and religiously been reading all the memos that you put out. Uh, my question was similar but a bit different than what Vishal asked. So I've been following the launch of the new small and micro cap strategy, and I wanted to ask you two questions about it. So my first question is, how is the portfolio selection process different from that of Stage One core portfolio? Are there any other risk parameters that you look at? Are there any other kinds of scuttlebutt that you do? Uh, how is that process been different from the Sage One core portfolio?
Sure. So the strategy, the scuttlebutt, all the evaluation parameters are exactly the same. Actually, we did not have a separate portfolio, which was a small micro cap versus a mid cap and small cap portfolio. What happened was, as the fund size kept on growing, we took a call that because we didn't want to increase the number of stocks in a portfolio. So it was, we would like to stick max to 20, but most of the time around 16 kind of stocks in the portfolio. So you have to do on an average about 6 to 7% allocation to each stock. So once you reach that size of say 1500 crores and 7% of that, roughly about 100 crores is sort of average allocation you need to do to a company level. It became more and more difficult to invest in companies which were smaller, anything below 3-4 thousand crore market cap. So rather than letting them go, we thought, let's launch something which is only focusing on those, because those kind of inclusions was getting more and more difficult in the core portfolio. Only focus on those in a separate portfolio where we will be able to limit the fund size that we manage. And that's where we only raised about 220 crores or something around that. And that became 500 crores. And about 3-4 months ago, we said we are not going to accept any new client into that portfolio, mainly because of the liquidity. So the liquidity is the only difference between the core portfolio and the small and micro cap portfolio. And if we raise more and more funds in that portfolio, it will defeat the purpose why we launched it. If that portfolio also start facing liquidity issue, because once you go towards like 1,000 crores or above that, again, then you'll be talking investing, 50-60 crores in one stock. And then you have to let go of many companies, because 50-60 crore in one stock becomes almost 2 crore 2% in a 2,500 crores kind of a market cap, right? So no, absolutely no difference in terms of evaluation parameters or the work that we do in each of the companies. Just liquidity is the only difference, and the less liquid companies we put into the small and micro cap, and then the liquid companies in the core portfolio.
Thanks, Samit. That was really clarificatory. I just wanted to follow up on that and ask, in case you discover more companies that are in a smaller range, and the small and micro cap fund continues to grow, are you planning like a series two, or will you then split like the small and micro cap even further?
So right now, that's not the plan. In case certain investors from small and micro cap want to book profits, or if markets go down and we find more and more attractive opportunities, when the size, so if the market is correct and our 500 itself becomes say 400 crores, at that point we would just open up the same small and micro cap or if we find companies which are little more liquid in the same sort of space, and we would be comfortable adding more investors, only then we would like to open up the small and micro cap, because we already kept some room for existing investors who would want to top up, because existing investors can add, because some of them do the SIP kind of investments. So for them, we have kept some room, even though, I mean, the average market cap for small and micro cap is about 6,500 crores. So we don't really invest in really tiny companies. The average, as I said, the entry market cap is below 5,000 crores, but we don't sell just because they went above 5,000 crores. So right now there is decent liquidity. So we will evaluate liquidity, and maybe we will try to time it when there is also more attractive opportunity, because we haven't had that 15-20% kind of a correction for the last 17 months, and you never know, it could happen. And for us, investors, making money is extremely, important. It should not just show up in our CAGR in taking invest, because we launched this in 2019 when it was sort of headed kind of sector. So we will stick to that. Take money when really it's doesn't seem to be the most favorable time to come. Right now, people are favoring sort of small and mid caps. But yeah, I don't. It's unlikely that we will launch, sort of series two. We do have an AIF. AIF is something which we are accepting money, and AIF is nothing but combination of both the portfolios. So all the stocks from both the portfolios will be in the AIF. 1/3 in the small and micro cap, and 2/3 in the core portfolio. So that's an option available. Our minimum in the small and micro cap as well as core is 2 crores each. Whereas in AIF, it's just 1 crore, and you do get access to both the portfolios.
Thanks, Samit. That was really helpful.
Yeah. Hi, Samit. This is Gaurav. Again, really appreciate the kind of memos you have been writing, and the kind of analysis you are able to do at a macro level on the stock market. So my question specifically was around the fact that lately many in the Indian stock market, there are not many tech-driven companies that are listed. Recently, Zomato got listed, and it has an amazing debut. But again, it's very difficult to kind of analyze how to value these kind of companies. So, what's your view around such companies? And increasingly, more and more such companies, as they get listed, will form a larger part of our market cap. So, how do you try to handle that?
Yes, no, you're right. I mean, we are struggling with that, because we have spent a lot of time evaluating Zomato. We are spending a lot of time evaluating Nykaa. And bottom line for us is that if this is a business model which we really don't have much handle on, because really these are very different businesses. We don't really have too much of history specifically in India. That means there is higher risk that you are taking, and for higher risk, you need to be compensated for that, with higher returns. So if we are anyways targeting, as I said, 2x in 3 to 4 years, here we would expect to make at least 3x. And when you try to see, in 4 years, tripling from today's price point, and then just reverse calculating what is the kind of earnings, or maybe sales, even if they continue to be loss making, that are needed to justify that valuation, it doesn't fit by a mile. That's the big problem, at least not based on what we are seeing. And as I said, it's these are mostly exits by the smartest of investors, in this company, and these models are pretty. They are not at the startup level. They have been there for a long period of time. So you can't equate them to like Amazon of 2000. And maybe if these were available 4 years, pre-launch of Geo, they could have been much more attractive. But right now, I think the low-hanging fruits are already taken away. They have penetrated into most of the markets which are easy to penetrate. The growth from here will be not that easy, and such growth, if it's available in businesses that we understand, we are comfortable investing in them, and we'll continue building knowledge on these businesses. But right now, I think the knowledge is not adequate enough, to take the jump.
So, Samit, so again, this brings to the other part of the question. Like I've been investing for some time in the market, but the big fear that among our group is that over a period of time, we are invested in companies, old economy companies who run the chance of getting disrupted by some of these emerging disruptors. And so, from an asset allocation point of view, how do you build exposure to companies that can potentially disrupt rather than being disrupted?
Yeah, no, absolutely, really good question, and that's what we also try to look at. We invest in companies which are the disruptors. So you look at any business that has really turned out to be, sort of multi bagger. It is because of the growth based on disruption. Deepak Nitrite was the first major plant, of phenol. So they disrupted basically the import which was happening from, China. IPL Apollo, I already spoke about. A lot of, API kind of companies which are currently are also disruptors because they are disrupting businesses, from China. Those are so it is extremely important to be confident that they are disruptors, and that's where if there is any doubt in mind that there could be someone else who could disrupt these businesses, you got to think very carefully about that. And for me, that market share gain is something which is extremely important. It gives you sort of reconfirmation that this company is a disruptor. And market share gain is something which confirms from a lot of other aspects, not just disruption, but growth, competitive advantages. And I may not have spoken too much in depth about the market share gain aspect, but that is the reason. That is one of the core parameter that we look for in a business.
Thanks, Amit. That was really informative. Thank you.
Karan, did you have a question, man? Yeah.
Am I audible? Oh yeah, I was speaking on mute, or I think the mute button's acting up. Hi, Samit. It's
Hello.
great to have you here. I have a quick question. You speak efficiently on the concept of acquiring market share, which is I mean, as from your performance as well as from how the markets have reacted over the last 10, 20 years, it's very evident to see. With the new disruptors coming into play, them in the next 3 to 5 years, 10 years in their growth story, from the angle of uh, uh, consolidation and formalization of the economy in the spaces which they're playing in, because I feel like the
Sure.
consolidation angle and the formalization angle is exactly what they're able to achieve as as they achieve unicorn status and so on and so forth. So how do you see that play out?
Right. Yeah, no, I mean, I agree with that. See, fortunately, the businesses in which sort of our portfolios, are invested in, they are more into, as I said, specialty chemical, CRAMS, API space, niche manufacturers, like Balkrishna or APL, Apollo, real estate, building material, those kind of spaces, I feel they are, especially export-oriented themes are the disruptors right now in this space. And the building material space or the real estate space, at least I don't see too much of disruption coming in that space. But you are right, the newer businesses which are getting listed, they are the disruptors, and they could disrupt a lot of other conventional businesses, which right now we are not in those kind of businesses. But if we were, I mean, we would have to think 10 times before. So I mean, these are the reasons why we are in these these businesses, because I feel the themes which I spoke about, uh, at least the export oriented, are the disruptors. And I think that structural disruption story probably will last for at least 3 to 4 years. That is generally my horizon. Whether it will last for 10 years or 15 years, I do not know. But at least at this point in time, it seems that theme will last for at least few more years to go. So your question is, I mean, absolutely relevant. Probably not relevant, from our portfolio perspective, and hence maybe I'm not in a position to answer it adequately.
Oh, okay. Fair enough. Thank you so much. I have a quick follow-up. So from your holdings point of view, how important is it to see that even though free cash flow grows and and reinvestment takes place, how important is it for you to see that the entry barriers are increasing with size? Is that a thing you look for in order to be able to look beyond 3 to 4 years? At which point? So I'm just trying to understand your framework
Yeah.
from the sense that, say, 3 to 4 years into the
Yeah.
investment, you have achieved the expected return or expected IRR that you were
Yeah.
you entered it, which you entered with the mindset. Will you
Right.
at the same point look at that the entry barriers have actually increased with the size, and we still have enough opportunity to hold on to something like this? So would that also be part of the framework in the mental makeup?
Yes. No, absolutely. You're exactly right. Because see, even though I start with a 3 years kind of a perspective, right? Many a times the stock can go up way higher than our expectations, and we keep on getting investments almost on a daily basis, right? So just because I got to invest at, say, Deepak Nitrite at 200 for the starting investors, can I invest right now at 1200? That is a question that needs to be asked for me every day, because do I see the earnings kind of profile even from today's point of view? Because if I am not feeling comfortable adding that stock in the portfolio for a new investor, I should question whether it should even exist in my portfolio. So the evaluation of competitive advantage, whether it's increasing or not, is almost a continuous basis for us. And again, market share gain is the end result of all of that. That is one of the factors that we look at, whether they have grown better than the industry, because that is the only way you can, because no one really gives you that market share gain number, right? It's just an estimate of. But if you know the competitors, and if this company is doing better than the competitors, you know that they are gaining market share. Secondly, most often your margin profile has to be improving. Otherwise, um, you don't want companies to go for growth which is inferior to their existing business itself, right? So, and when you are looking for this 25% kind of a growth, capex is going to be one of the most important factors. So you have to look at the incremental return on those capex that you are putting in. And after all, it is going to be your own estimate. Management obviously will guide you, but you have to estimate based on what kind of products they are getting into, what kind of market there is available, and you got to look at the cost structure and all of that, and evaluate what is the return on investment on those incremental capex that they are putting. Because same thing is happening with APL Apollo, same thing is happening has happened with Deepak Nitrite. they spend those 1,500 crores when they put up the phenol plant. Even today, they're talking about the same kind of investment, because without that, they can't grow. And so, it's almost like a perpetual evaluation that you get into once you add that stock in your portfolio. And especially it's important for a fund manager who gets money, and you have to invest that money at various points, starting point for investor. And I have to be, confident that even at 2200, I see potential of earnings doubling in the next 3 to 4 years, and the valuation even now makes reasonable sense.
Absolutely. Thank you. Just one last quick follow-up on the understanding of your behavior to react. So, for example, equity investing in India is still very young. I'm sure you would agree. Even though even for your even for your PMS investors, even though it's a higher ticket size, the ability to understand, the ability to behave appropriately, you would still agree that it's extremely premature. Although you are handling it from like there's irrational behavior involved when the investors involving their own fresh capital into your fund, right? So how do you then react to, say, for example, you achieved IRR on a stock and you actually are not seeing any growth, right? How are you taking emotions away from it when you're actually about to exit something? Because as you rightly said, if you're not entering a stock which you already hold for an existing client for a new client, then you're going to question your entire thesis as to how you're still holding it for somebody else, right? So at which point, how do you react in a way which is absolutely unemotional and absolutely clinical and ruthless in the ability to in the ability to execute a trade or decision like that? Just a little on the
Right.
mental side of the thing.
Sure. Yeah. So, see, I covered this aspect a little bit, with Ishmohit, that, exiting is, in many situations, it's sort of, two sides of a coin, because either both sides, either you can get it like really wrong, because you exited it too early, because exit happens if you see slowdown in growth, which could be temporary in nature a lot of times, and you would extrapolate that, saying that, okay, there is a structural story, that's a conclusion, and it could be a completely wrong conclusion. So that is an error, which is the costliest error. If you get out of a company too early in a long structural story, because you do not get these large, huge multi-baggers that often. So once you find it, you got to ride it as much as possible, and sometimes it may seem that it's become a 10 bagger and 20 bagger, but in a long term structural story, even 100 bagger, 1000 bagger is a possibility. You don't want to exit. So that's where, you have to evaluate very carefully whether it's a short term hiccup, or is this a really damage to the structural story. You have to spend time. It's okay to be a little bit late, especially in a non-cyclical businesses. Even if you are a little late, that's okay. It's not that the tide really just crashes. So but you have to confirm that it's a structural story which has changed. And so most often you will know, whether something which, so for example, I'll give you, Laopala, we were invested, in 2000 and around 13 times. At that time, they had gone for new capex, because India had put in anti-dumping duty on import from Taiwan and China for, those opalware. And knew that Chinese and the import market was about 50%, and 50% was Indians. So when the anti-dumping duty was there for 5 years, it was natural that Laopala will go through higher phase of growth over the next 4 to 5 years. And then it happened, right? But beyond that, that it was that kind of a story. Once that market share gain happens, where are you going to get that incremental growth? You cannot. Then the market share story, when it ends, you know that the growth will drop down to that 10-12% kind of a nominal level, which is for the industry. And you exit because you can't see the growth. And the stock, during that phase goes through that expansion phase of earnings. And at the same time, the P multiple gets re-rated. And then post that market share gain, if you look at their growth, it's very nominal. So once you understand the business, once you understand the drivers behind why there is growth and why there is market share gain, I think the decision becomes easier. There is no shortcut to understanding the business.
Absolutely. And just a quick one. So say for example, you identified something absolutely spot on. You held on to it. It's earning significant free cash flows. It's reinvesting appropriately. It's growing. It's growing. It reaches a point where you are seeing that the growth in its own specialty area is not as much, and it has the ability to understand the future growth of the entire sector, and it has the ability to make a small little pivot into an allied angle. Would that still be of interest to you, or are you going to wait and watch on something like that, because you are increasing a revenue stream from another angle in a company you hold on your existing portfolio? Have you seen any examples like that where you had the feel to exit, but you saw that it has appropriately made a small pivot with free cash flows, and it has it has the ability to grow into the small pivot it's made and increase revenue streams?
No, absolutely. I mean, see, market share gain in the same products or same industry is one of the triggers. I mean, that's not the whole and soul behind the growth. The companies typically, if you see the long-term structural growth stories, they will grow by taking away market share, but at the same time, they will get into multiple verticals. I mean, just look at Bajaj Finance. They were only into the three-wheeler, two-wheeler. It was Bajaj Auto Finance. It was more of a captive financing. When they brought in the professional management, they completely changed the verticals in which the growth came in. And that happens, whether it's an APL Apollo when they launched those door frames in Tricot. It was very different new products. Now when they're launching planks, which are more of products rather than you selling in kgs. Initially they were just selling fabrication pipes, which are sent in trucks. Now here they're selling maybe units. So you have to evolve. You got to identify the spaces where you are really good at, where you have similar or more competitive advantages, and look at opportunities. I mean, those are the ideal kind of promoters that you want to look at. And if that is happening in any company, in addition to, even if it's slowing down the growth on just the market share on the existing product, you got to give it some time, and you have to have some patience. So let it slow down its growth for maybe short period of time, but if you have the confidence in the execution capability of the promoter, then it's worth the wait.
Right, absolutely. I have just a follow up for you from your growth as a fund manager, right? From your own issues of of execution in terms of ability to think through things. I'm basically allying to cognitive biases which you have overcome in your career, which you see when you look back, you can say that I have grown as a person, as an executioner, as a fund manager. Which, say for example, I wouldn't have taken this decision 6-7 years ago, but I have the ability to do so now through the wisdom and experience that you have gained in the course of your career. Something on those lines, just to give a sense to the retail and the average investor, how you need to think through things instead of just like focusing on price kya hai, market kya karegi.
Right. No, so see, biases generally come from your entry level. So I mean, for a fund manager, that becomes like a really the big difference between you as an individual investor versus you as a fund manager is that most of the time individual investors say, if you enter Bajaj Finance at 50 rupees, and that 50 rupees becomes 500. You have so much of cushion that because of your entry price, which actually is a bias. It's an error of thinking. But when you become a fund manager, those aspects become more and more important because you are going to be buying for newer investor at various points in time. You will be buying it at 5,000, and which can be 100x more than when you initially bought it. So as I said, you read, but you think a lot about different biases that crop in, which are just errors, which sometimes as an individual investors, I've heard stories about individual investors, entering at a price of 100 and then becomes 200, they double the money and they book out the profit. And now they start thinking that it's a risk-free money for me. But I mean, it's not, right? After all, you have an option to get out at 200 the entire thing and reinvest that money somewhere else. Just because you invested somewhere else, it doesn't become a risky money. And you just book profit and you think that the remaining shares are free for you. It's just a bias and anchoring that you do. So as a fund manager, those sort of mistakes or biases that you let go as an individual investor, you have to be spot on with that, because you can be doing right, and some investors who got it at that price will not question you, but there will be 10 others who will be on your head if the price drops from 500 to 400, and you are answerable to each and every investor, not just the initial ones.
Absolutely. Thank you so much, Samit. Thank you for answering my questions.
My pleasure.
Hi, Samit. Just one question from me and two from the audience. Since you mentioned the AIF, also there seems to be a lot of confusion about how the process works differently from a PMS, because when you're holding a PMS, you're holding the stocks in the individual client's name, and they have some degree of liquidity that's available to them if they want to pull out, and if at a time earlier than 3 years. But I don't think that the same option is available in your AIF. So that, and how does it work in terms of holding level or tax level? So that's the question from me, and after that I'll ask you the two questions from the audience.
Sure. Yes. So you are exactly right. PMS is an open-ended structure where the holdings sit, in your demat and under your name. In the AIF, you get units, so it's more comparable to a mutual fund. But even mutual fund is an open-ended structure. AIF is a closed-ended structure that we have, and the reason being taxation. I mean, there are AIF generally is a trust structure, and trust can be classified as indeterminate, meaning that you do not know the exact set of investors who are the beneficiaries, or determinate, meaning that the investors are known. Indeterminate trust has full taxation, which means 43% most of the time, and indeterminate or determinate is the regular short-term and long-term. Absolutely have no risk of investors changing. We made it a closed-ended structure, and then at a trust level, you pay the short-term and long-term capital gains based on whether you exit the stock within a year or beyond one year. But you are right. AIF is a closed-ended structure, so neither can you, once the fund closes, neither can you add money or you redeem money from an AIF. There are many AIFs who have kept it open-ended, but according to me, that's a little aggressive stand on taxation, because you never know, 2, 5, 7 years down the line, the IT guys may come after the beneficiaries saying that the trust of which you are beneficiary of only paid short term and long term, whereas your trust was an indeterminate trust. So you are liable to pay full taxation and there could be penalties. And we didn't want to take that kind of a risk. And hence it becomes a closed ended where you can't really take the money out. The advantage only from an investor, if I had to, whoever can come into the PMS, with 2 crore minimum, absolutely that gives you a lot of flexibility. On the AI side, two advantages. One, within that 1 crore, you do get exposure to the small and micro cap as well as the core portfolio, 1/3 and 2/3. Second is the fee structure is 25 basis points lower. And the third advantage is that if you end up choosing the profit sharing fee structure on the PMS side, you end up paying the profit sharing at the end of the year, every year, if obviously if eligible. But in AIF, we will only charge the profit sharing when we return the money back to the investor. So that money will keep on compounding, rather than we charging the fees to the AIF investors. So hope it clarifies the differences between the two structures.
Yeah. I just had a follow-up question based on what you said. So one, is there any difference in terms of the disclosure? Because I mean, I'm not invested with your PMS, but I am with another one, and we get to know on a regular basis as to what is going on inside the fund. So would the disclosures be the same? That's my first question. And second question is, since you're taxing these investments at the fund level, is there any taxation at the time of redemption, like at the time when the fund closes, in the hands of the beneficiaries, or is it all taxed and done with you guys, and then what we get in hand is like essentially already been taxed?
Yeah. Yes. So on the tax part, the taxation is at the trust level, not at the individual level. So what you get back is the net of tax and net of fees, net in your hands. No tax beyond that level. On your question of disclosures on the PMS, you're right, because the PMS is in your demat holding. Generally, when we sell the stock, you get an intimation, as an SMS from the exchange and from I think NSDL also. When you buy, I don't think you get an intimation, but you can still access through login into NSDL and know your holdings, whenever you have addition. So you do get, but from a PMS perspective, we do send out a monthly statement to the investor at the end of the month. What are the buys, sells, all kinds of details of taxation and capital gains, and full pretty big deck of statements. For AIF investor, the disclosure of stock holding happens once in a quarter. But they do get monthly statement, but it doesn't have the stock level details. It only has your, NAV and valuation. But yes, the disclosure will be once in a quarter versus once in a month for the PMS.
Thanks, Samit. This was really helpful. Now for the question from the audience, there are two questions, but they're both in the same line, so I'm going to ask them together. So people want to know that what is the process of a research idea, making it from something you come across to investable in just broad phases. If you could clarify. And I know I've asked this question before, but people want to know that is there any additional phase for microcap? I know you've answered it, but they don't seem to be satisfied with my response.
Sure. See, so one is the identification phase, where the sources of identification can be either from your own screening and filtering process that you do on the databases, mostly on a quarterly basis. So that is one way of sort of getting the stock shortlisted as an idea to explore further. It can come from some brokerage houses, because as a PMS or a fund house, you do work with 5 to 10 different brokerage houses, so you do get comfort from specific analysts where you have long history with, and they may recommend, okay, this is stock you have to look at. So you do get recommendations from the brokerage houses selectively, and then your own set of investors, investor friends, where the kind of investors who are following the similar kind of strategy. So they also recommend, okay, I went visited this, I really like it. So that becomes the starting point. Those mainly three source of ideas. Once you decide to evaluate it further, then some one of our team members will look at its financials, look at its history, more desktop research, annual report reading, and basic research that needs to be followed. If that idea still makes sense, if you still like that business based on desktop research, then you connect with the management, asking for an interview with the management, meeting with the management. So where you generally these days you start with a video call, and sometimes you start with IR and CFO, and then next you will do it with the promoter or the CEO, whoever is running the business, and you further like it, then you request for a plant visit, and then you go for a plant visit. In the meantime, you also try to talk to the competitors, because you can't just evaluate business in isolation. You have to understand the competitive advantages and what is the differential between that company and the competition. So you then start also parallelly talking to or researching the competitors. Not necessarily you will end up speaking to all of them or visiting everyone's plant, but wherever you find there is it's relevant. If it's relevant to compare how the plants are, how different they are, then you do it. Whatever is needed to add that conviction, you try to do it. And parallelly, you also actually start talking to the supply chain. So there are distributors or vendors. Fortunately for us, there are many of our investors who are vendors to a lot of companies, including specialty chemicals, some in manufacturing, auto side. So you do get a lot of insights. They will connect you to someone who is relevant, who understands the industry, because it's all about gaining knowledge of the industry. It's not about gaining data points about the company. It's more about just understanding the overall nature of the industry, the competitive advantages, how the structure is. And the more you talk to different participants who are relevant in explaining that, the more knowledge you gain. And at the same time, you also try to do background check about uh, promoter, their history, especially in the small and micro cap. Probably that will be one of the incremental things that you need to do even more carefully, because some of them may not have too long a history. Not many will know about those promoters and businesses, because of them being not having that long a history, or smaller businesses, maybe regional businesses. So there you need to be doing little more micro level of investigation into the background of promoter, maybe at a local level. And yeah, and once you get the overall comfort, then you take a call, whether you want to go ahead with the investment or not.
Thank you, Samit, for the absolutely detailed response. It had so much depth to it. I just received a bunch of thank yous in my back channel, so just wanted to convey them to you.
Thank you. Thank you.
And with that, I think we're going to close the session for today. I just want to, on the behalf of everyone at Delhi Investors Association, give you a big shout out and a big thank you for taking your time out and engaging with retail investors directly. We've all been watching you on television, waiting eagerly for when your memos come out, and to be able to have this experience to share a virtual stage with you has been an absolute privilege. So just wanted to say a big thank you, both from me and from all the other moderators who have just stuck around and been glued to their phones without moving for these past 2 hours and 15 minutes. It's been an absolute privilege, and thank you so much.
No, it's absolutely my pleasure. I've never done this before. I do not get to interact too much with broad base of investors, and it's it's a very different experience, and the kind of questions probably are more sophisticated than a lot of experts who end up asking such questions. I mean, it shows the maturity of all of you investors. Um, and absolutely it's a pleasure, and hope it added some value, because I know a lot of investors do it these days. There are a lot of clubhouses meetings, you get to hear from the best of investors, but hopefully even this interaction added some value to you, and it will be helpful.
Yes, sir. Absolutely, absolutely. In fact, this is the first time ever that I've tweeted out almost 18, 20 tweets with all the highlights, not only for like the for our DI community to read, but also for me to go back and look at. Those small insights, these indicators that you've given, wisdom nuggets of wisdom all throughout this call. I've tried to consolidate them, and I'll revisit them from time to time again. So I think the value is absolutely unquestionable here. And like I said, it's the privilege of each one of us here on stage and in the audience to have this time with you. Thank you so much.
Thank you so much. It really means a lot. All this feedback. To all the moderators, also Ish, Mohit, to take out time and moderating this. Even Saket, Saket ji is I know him for a long time, and he invited, and I just jumped onto it. So thank you so much.
Thanks, Amit. Thank you.
Thank you so much, Samit.
Thank you,
Really
Samit.
insightful.
Thank you, Samit ji.
Really love this session. Thank you so much for doing this.
Okay.
Thank you,
Thank you.
Samit bhai. Thank you,
Thank you.
Ish Mohit.
Bye.
Thank you all.